It does take us to our talk of the tape, the state of this rally, whether it's too tech heavy, as some now say, it is actually worse than the bubble of 1999. Let's welcome in Josh Brown, Ritholtz Wealth Management co-founder, CEO, also a CNBC contributor. But let's deal with this market on the cusp of history, something extraordinary, I think, S&P 5,000, given where we were and how fast we've come to the doorstep.
Yeah, and just for fun, I went back and looked at when I first launched my blog in November of 2008. The S&P 500 at that time was like 700. The NASDAQ was 12. The NASDAQ 100, 1,200. The Dow was under 8,000. And look how much has changed between then and now. And the entire way up, there were so many reasons to just give up, throw in the towel. The market's too tech heavy. It's too oil heavy. What about geopolitics? What about the election, Brexit, COVID, et cetera, et cetera, et cetera, the Fed every minute of the day. And the people that stuck with their investments and have made it to S&P 5,000, I think should be commended, because think about all of the things in the backs of all of our minds we've all had to contend with on the way here. So is it too tech heavy now? Is that the biggest criticism? Okay, I'll accept that. The thing is, market returns have been tech heavy since 2016, when the cloud had its coming out party after Amazon announced that shocking out of nowhere profit that no one was expecting. Ever since then, and think about how long it's been, ever since then, 8 years, we've had a tech-heavy rally the entire way up. The only time it wasn't tech-heavy was when the market fell in 2022. Other than that, that's what has led us from there to where we are right now, which is just shy of 40,000 on the Dow, just shy of 5,000 in the S&P. Hopefully we'll hit that in this hour. And when you think about these milestones along the way, mathematically, they're unimportant, but I think from a sentiment perspective, they are a reminder that most of the time, the meteor misses planet Earth.
Do you take any pause in how fast we seemingly have gone here from, the October lows, from November 1st until now? It really has been nothing short of extraordinary. The pace and the size of the move, theoretically on expectations that the hiking cycle is now in the rearview mirror and the Fed's going to cut, and that is really all that matters at a time where the economy is held up incredibly well.
I think one of the things that is worth pointing out alongside everything that you just said, and all of those are true things, earnings growth has been explosive for the areas that are getting the most attention from investors. It's not as though investors are playing in a group of stocks that don't have good fundamentals. I was looking at my board just now, looking at CrowdStrike up almost $20 on the day. They didn't report today. There are so many stocks like that in enterprise software, in cyber, in cloud, semiconductors. It's not really just 6 stocks. There are 6 very important stocks, but then there are hundreds of companies with earnings growth, 20, 30, 40%. Those are the stocks that are working right now. It's not some peculiar group of names where we're all laughing and making memes. That was 2 years ago. These are the best earnings growth stories in the market. Are they going up too fast? Perhaps. I wouldn't argue with that. It's getting a little bit extreme. I said that on the show yesterday. But if that's your biggest quibble, that they're going up too fast and not, these are terrible companies, or, earnings are falling apart. If that's your biggest quibble, then do yourself a favor. Take something off. Trim something. That's what I'm doing. Sell your least favorite stock. I did that yesterday. It's okay. You can stick around and not be taking the biggest risk at the party.